What's up, guys? I'm Kay Scholl. Welcome to another financial awareness video. In this video, we're going to review and discuss the 2021 federal income tax brackets and 2021 retirement account contribution limits and phase-out limits. I'll leave a link in the description below directly to the IRS website if you want to check that out. And to make your life a little easier, if you want to skip ahead to the part of the video that applies to you, go ahead and check out the chapter links noted in the description as well. Okay. Here are your 2021 federal income tax brackets. If you're single, you'll pay 10% on the first $9,950, 12% on your income between $99,551 and $40,525, 22% on your income between $40,526 and about $86,000. You'll then pay 24% on your income between $86,000 and $165,000, 32% on your income between $165,000 and $209,000, 35% on your income between $209,000 and $523,000, and anything over $523,600, you'll owe 37%. If you're married filing jointly, you'll pay 10% on the first $19,900. You'll then pay 12% on your income between $19,901 and $81,000, 22% on your income between $81,000 and $172,750. 24% on your income between $172,751 and about $330,000. You'll then pay 32% on your income between $330,000 and about $418,000. You'll then pay 35% on your income between $418,000 and $628,000, and anything over $628,300, you'll owe 37%. If you sell any of your investments within 12 months, that's short-term capital gains rates, and short-term capital gains are taxed at the same rates as your federal income tax bracket where you fall. The long-term capital gains rates are as follows. If you're single, you'll pay no capital gains if your taxable income is under $40,400. 15% if your taxable income is between $40,400 and $445,850, and 20% if your taxable income is over $445,850. If you're married filing jointly, you'll pay no capital gains if your taxable income is under $80,800. 15% for your taxable income between $80,800 and $501,600, and 20% if your taxable income is over $501,600. The 2021 standard deduction has also slightly increased. If you're single and take the standard deduction, that amount is now $12,550. If you're married filing jointly and take the standard deduction, that amount is now $25,100, an increase of $300 from 2020. Now, regarding the 2021 retirement account contribution limits, those remain unchanged from 2020, meaning that the 2021 401k or 403b contribution limit is still $19,500 with a $6,500 catch-up contribution in addition to that for those aged 50 or older. The 2021 simple IRA contribution limit remains $13,500, and the 2021 traditional IRA and Roth IRA contribution limits remain at $6,000 with a $1,000 catch-up contribution in addition to that for those aged 50 or older. However, what has changed for 2021 is the income limitation and phase-out ranges in order to be able to contribute to a traditional IRA and get the deduction, or contribute to a Roth IRA. If you're married filing jointly and make under $105,000 a year, then you can deduct your full contribution into your traditional IRA up to the contribution limits. But if you make between $105,000 and $125,000, you start to get phased out. And if you make more than $125,000 married filing jointly, then you can still contribute to your traditional IRA from your checking account, but you won't be able to get the deduction. Married filing separately remains unchanged. And if you're single and make under $66,000, then you're good to go for the full deduction for your traditional IRA contribution. But between $66,000 and $76,000, you're starting to get phased out. And if you're single and make over $76,000, then please feel free to contribute to your traditional IRA, but you simply won't get the deduction due to being phased out. Now, follow me on this. If you're married and one of you is covered by your retirement plan at work and the other one of you is not covered by a retirement plan at work, then your phase-out range is between $198,000 and $208,000 in order to get the deduction for the traditional IRA. Anything below $198,000 in that scenario, you're good to go. Now, you might not be aware of this, but if you're married and neither of you are covered by a qualified retirement plan where you work, then you have no income phase out limits at all and can get the full traditional IRA deduction for the amount you contribute. Now, I used to be a financial advisor for over 8 years, and discussing the Roth IRA was a highly emphasized topic. Regarding the Roth IRA, if you're married filing jointly and make under $198,000 of modified adjusted gross income, then you're good to go to be able to contribute up to the max for the Roth. And you start to get phased out between 198 and 208. And anything over 208, the Roth no longer becomes an option for you. If you're married filing separately, the phase out range remains unchanged. And if you're single, then your range is now 125 to 140. And for those of you single making over $140,000 a year, then contributing to the Roth is a no-go for you as well. But please do some further research because you may have more options like the backdoor Roth IRA. If you've got a little more time in your hands, then you'll really like a few of my other videos where I discuss deducting your vehicle, tax bracket management, Roth 401k versus pre-tax 401k, traditional IRA versus Roth IRA, my favorite tax deductions and tax credits, understanding your effective tax rate versus marginal tax rates, or figuring out if you're saving too much or not enough for your future. Or, I don't know, maybe you'll like my retirement planning playlist. If you got any value from this video, do me a favor and tap that like button. If you have any questions for me, let me know in the comments below. I appreciate your time. See you in the next one.